Hi everybody, this is Chris Maxwell with the Fire Me channel, and this was a fantastic year for our Wealthsimple Trade $1 million portfolio. So as most of you that have been following the channel know, we are trying to build a $1 million portfolio using nothing but passive income sources and side hustles and things that are basically not our primary income sources. So currently most of the portfolio has been funded by our money that we've saved from the Cut the Cup challenge, as well as our recyclables. If you haven't seen that video yet, I think it's in the side hustle passive income source playlist. So basically cans and bottles and recyclables that we get from the house, we're able to cash those in and get a fair bit of money for them actually. So that's how we have initially funded this portfolio. We've bought a few shares, and let's go through and see how we've done. Okay, so our first purchase that we made period was JPMorgan. We got one share for $99.19. Current price as of this video is $136.84, and that has been a net gain of $37.65, or 37.9, basically 38%. Great gain. I thought JPMorgan would be a good investment. I never dreamt that we would be up close to 40% on it. It's one of the pillars of our portfolio. Now, do I expect it to stay here? I suspect it'll have a pullback at some point, but great way to start off with this portfolio. Really happy with the returns we've got on that. I wish we had more money so we could have bought even more shares of it. But, you know, it's a great starting point. If you haven't seen some of the previous videos, what we're trying to do is get 5 pillars of our portfolio to start. Big companies, well-established, good dividends, best of breed. JPMorgan definitely fits into that. And we've done very well with it. So I hopefully you guys that have been following along have bought some of that as well and have done just as well as we have. All right, the next company, Ventus. So over the past few months up to this point, we've accumulated 2 shares of Ventus. We've averaged, the average price has been $63.73 per share. We did average down a little bit to get there. The current price is $59.47. So there was a net loss of $8.51, or 6.7%. Now, for those of you who don't know about Ventus, Ventus is a senior living REIT. They also have research properties, and basically what the company does is it buys old folks' homes, or the real estate for old folks' homes, and research properties that, say, a government or a university would lease. And they don't actually operate these properties, they just own the real estate and lease it. I really like this business model. They're senior living properties. You know, they have an operator come in, just rent the building from them, and basically just run their business. If Ventus doesn't do anything but collect the rent. Now, the other thing that is really a big plus for Ventus as well is interest rates are incredibly low right now, and I don't foresee them creeping higher in the future. If anything, I think they're going to go lower. The current administration in the US is really pushing to keep interest rates low and the economic activity fairly high. So that's great news for Ventus. The reason why this company pulled back a little bit, they didn't have quite as good of numbers as what the street had wanted, so they got punished. But long term, I think this is a great investment. More and more baby boomers are getting to the age where they're moving into these type of facilities, and I think it's just going to be a really great way to play this market segment going forward. If you don't like something like Ventus that is in this specific line of real estate investments, there are lots of other REITs that are good. Brookfield is a great one. They primarily have commercial and properties like office towers and things like that. So for our portfolio, I've chosen Ventus. substitute a REIT that you like if you prefer something else. But I do suspect that over the next 12 months, this small loss will actually turn around and will be showing a net positive position here. All right, Delta. This has been a fantastic trade. I'm very happy with this company. Delta's best of breed for the airlines. They have no exposure whatsoever to the Boeing MAX or 737 MAX. Zero impact from that whole disruption that a lot of the other airlines have experienced. So we purchased one share of this for $53.75. It's currently trading at $60.34, so that's a net gain of $6.59 or 12.2% return. Delta typically trades between $50 and $60. It's an incredibly cheap company. The price to earnings ratio is very low. So what I like to do with Delta is just kind of track it through that $50 to $60 range. And when it starts creeping towards the $50 range, that's the time you want to look at picking more shares up. It seems to be fairly consistent, at least in the recent history, bouncing in between that range. Now, the one thing I am quite surprised with is that given the current with the current way the stock market has been, with everything being so hot and so, I don't want to say overpriced, but valuations have been stretched a fair bit. Delta is still a good value stock right now. It hasn't had a big breakout past the $60, which I thought it probably would. But so if you're looking for a good valuation, Delta is a great company to look at. Well run. Do your due diligence and your own research, but I really like this in terms of an airline stock. All right, Chevron, another great addition to our portfolio. Like I mentioned, we're looking for the initial trades to be the pillars of the portfolio. This is definitely one of them. It's the best run, best of breed integrated oil company by far. Exxon's a great company as well, but Chevron actually has a better balance sheet and, in my opinion, probably a little better management as well. It's hard to say whose management's better, but Chevron's a great run company. I really like it. So Chevron, we purchased one share for $117.80. The current price is $113.31. So net gain or net loss, is $4.49, or we are down 3.8%. This investment have only just recently purchased it, so the amount that it's down is only like fluctuation of a day. It could be back to the green, so I'm not concerned with it. These things go up and down based on a variety of factors. Crude prices primarily will drive a company like Chevron. Also, when they pay the dividend out, the stock typically, or any stock, will take a small dip, but a great run company, great balance sheet. It's in the energy sector. Some people don't like oil and gas, but we are far from eliminating oil and gas from our daily lives. Everything's made out of it. Every piece of plastic, packaging, you name it, transportation, fuels. So Chevron's going to be in business for a long time to come. There's just no getting away from this stuff. So that's our energy pick. There's lots of other companies in the sector that could be interesting. Some people that don't like the producers might want to look at a utility or a midstream company or a pipeline company for their portfolio, but I think Chevron long-term is going to do pretty well for us here. Okay, now to the last piece of this portfolio review. It's a company that we had on the previous portfolio review we did, and that's Apple. Now, I don't want to say I got greedy, but we had a bid in for Apple previously at $190. It did get down to $193, and I was stubborn. I held out for the $190, it never made the strike price, and at that point it turned and went, it's well over $300 at this point. So anything below $200 to me was a good deal for Apple. I should have just bought the share. I wanted to kind of demonstrate our discipline by not buying until it hit our target price, and that, you know, long term, if you're doing this, that's probably the right approach. Never worked out in this instance, but typically if you stick to your discipline and the strike price that you're looking for, that's a good approach to look at any investment. You know, not now I'm crying over spilt milk because we never got the share, and we could have made over $100 a share on this already in such a short amount of time. However, long term, Apple has been known for these really dramatic pullbacks, up to 40%, and it's not, you know, oh, it only happened once. If you look at Apple's stock price history, there's lots of examples where they've had significant pullbacks, and you know, the sky's always falling, it seems like, when these things happen. And you know, once it gets 35-40% pullback, it's probably a good time to get back into Apple if you aren't currently into it, or if you want to add to your position. That being said, we are going to be buying a share of Apple for our portfolio. It is the fifth and final pillar of it. I don't like the valuation here. I love the company for a variety of reasons. The products are fantastic. The service revenue is growing. There's just no way that someone that's into the Apple ecosystem is going to leave it and go to Android when they've got thousands of dollars of movies, videos, music, etc. purchased through Apple. Like, once you're into the Apple ecosystem, you're there for life, essentially. So we are going to pick up a share. Like I said, I don't like the valuation, but that's the final pillar of our portfolio. We'll be waiting for a significant pullback before we buy any more shares, but I just wanted to get that investment on the books, just so we can have all 5 pillars in place and start building on those. We'll also be looking at getting some shares of the Vanguard 500 or S&P 500 index fund, and the Berkshire Hathaway probably Series B shares as part of our $1 million portfolio. I'm not considering them the pillars of the portfolio, but they're more like a mutual fund. Both of those investments, Berkshire's got a vast array of businesses that fall under the Berkshire umbrella. S&P 500 index, self-explanatory, and the Vanguard is the cheapest index fund, low cost, and that's a great fit for this portfolio. So those 2 investments, when we get those, will kind of be our mutual fund type component to the portfolio. So yeah, so keep tuned, or stay tuned for that, and make sure you, if you haven't already, subscribe so you can keep following us on this journey to $1 million. But that's kind of our core investments right now. All right, so I just wanted to run through our summary results with you guys as well here. So total invested to date has been $398.20. The total current value of the portfolio is $429.43. So that's a total return of $31.23, or approximately 8%. So we've done quite well. So obviously some of our investments have done incredibly well, 30+% returns. Some have lost a small amount of money, but that is why it is so important to be diversified, not only in different companies, but different market segments. So in our case, we've got tech, oil, airlines, REIT. We are well diversified in the market. We're well positioned. We've got best of breed companies, and it's definitely going to serve us well in the long run. So anyways, I hope you guys are enjoying following our $1 million portfolio challenge. Make sure you give this video a like, subscribe to the channel if you haven't already. We've got lots of great videos. Our $1 million portfolio, IPO portfolio, our financial education videos, dividend investor videos. There's a whole lot of content in here, something for everybody. And I hope you guys are really getting something out of this. It's been a lot of fun for me so far. And I'm just inviting you to subscribe. And yeah, just make sure you leave your comments below. And we'll see you guys in the next video.